Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 27, 2017. Excuse me. It's about 1:17 p.m. Eastern Time right now as I'm starting this video, and I wanted to go over a few things. Most, if not all of this, I've covered in the last week or so. I've gone over the sectors that stand out to me, both bullish and bearish, whether it's commodities, individual sectors. Had quite a bit of stocks, as I've made mention, and I think most of us know this market, although the primary trend in the broad market has clearly been bullish, there has been a tremendous amount of sector rotation. So I'm looking at the best opportunities, whether they're long or short, whether they're stocks, commodities, you name it, where a clearly bullish or bearish chart pattern is, that's where I'm focusing my efforts. Broad market's getting very frothy. I could care less about the resiliency of the trend. You don't have to fight it with broad index shorts, but you can certainly pick out the most bearish sectors and the most bullish sectors, because there's plenty that have already taken it on the chin and are now seeing money come back in. So let me just continue to reiterate: trade stocks, not the market. At least that's my mantra. And that includes down to sectors. If you're, we are in the thick of earnings season, so as you guys know, earnings induced gaps can go for or against your position. So when you use an ETF, a sector ETF, that does help mitigate the risk of a gap against your position. Won't eliminate it, but it helps to mitigate it because you have a lot of holdings in there. So let's just take a look at one thing here. This is the Dow Industrials, the Dow 30. And you can see it here, bearish rising wedge, really pretty clear, well-defined uptrend line here, clear negative divergence. And I'll tell you, if I've heard it once, I've heard it 1,000 times in the last few months, last 6 months or so. A lot of folks saying technical analysis or negative divergences no longer work. First, to that point, and I've been saying this for years, and I've always said it, nothing works 100% in trading or technical analysis. If it did, we'd all figure it out, and that would be the one thing to look at, and we'd all be rich and making money. But as I say, much more often than not, these divergent highs, especially confirmed with trendline breaks and other sell signals, do play out. If not for a huge rally or correction, when I'm talking positive divergences or bullish, negative divergences, such as we have here when prices are making a higher high, and yet the indicators, price and momentum indicators and oscillators below are making lower or equal highs. In other words, they're not confirming the higher highs. That's negative divergence. So we had negative divergence back here in the Dow. And although it didn't play out for a monster correction or anything, it certainly did. It dropped both in time and price. You can see we slogged around sideways for several months there, and then broke out of that trading range and resumed higher. So the divergences did play out in both time and price, as you can see here. Now, what do we have? An even larger divergent high, really an extension of those previous divergences. Therefore, such, my expectation would be for a deeper correction if and when that trend line breaks. Just because technical analysis, the trend is strong, these sell signals haven't been working as effectively as they usually have, that doesn't make me abandon something that has worked so well for so many years. It just shows that in recent months the demand for stocks has by far overwhelmed the supply. So that's the Dow. And the reason I'm looking at the Dow, most of you guys know I hardly ever mention it because it's only 30 stocks. And 30 stocks is not very representative of the overall economy. I prefer indexes like the S&P 500, Wilshire 5000. Look at the small cap stocks as well. These are all large cap blue chip companies. But what I wanted to get at here is talk a little bit about Dow Theory. You can Google that term. It's something that Charles H. Dow came up with back around the early 1900s, so the turn of the 20th century. And originally, what he looked at are two things. Back then, we only had the railroad index. We didn't have the Dow Jones Transportation Index. Why? Because we didn't have trucks. Everything was horseback, moved on horse or rail. So since then, we had both the airline industry evolve, aviation. So now in the transportations, you have airlines, you have trucks, and you have railroads. I've made it very clear recently that I've seen extremely bullish chart patterns, and everything has been following through recently on the railroads and the airlines. So let's just look at the transportations for a second. And the Dow Theory really talked about, Charles Dow was looking at the rail stocks, which we'll get to in a second if there's time, as sort of a leading indicator, because as you guys know, rail, transportation, more so back then, but even to a very large extent today, that moves the goods, the products that we buy within the country. They come into either a port or they're made, domestically and then transported by rail and or truck. So, that and or plane as well. So that all goes into the transportation index here. This is a very clear very large bearish rising wedge pattern. You can see this impulsive price action. In the last couple of weeks is when I started highlighting and talking about a correction coming in the transports. So what am I getting at? We just looked at the Dow Industrials trading up near new highs, yet the transportations are not only now well off their highs, but they're threatening here a break of this major support level. Now this is the first tag of that trend line in a while. I wouldn't be surprised to see a bounce, a reaction. Anything's possible. It could go on to breakdown. There's a big gap there to fill. But again, very bearish, not only a very bearish technical chart pattern confirmed with negative divergence. We're now at a precarious position here at testing that uptrend line support. This is now the fourth reaction on that trend line. Again, maybe a bounce, maybe another thrust within the wedge. Doesn't matter. Could break down today, tomorrow, and if it does, transportations are heading lower. And again, why is that important? Well, it's not confirming the move higher in the Dow as well as the S&P. And then you look at some of these leading companies. You guys for those of you that have been investing or trading for a while, 10 years or more, you probably remember the term Dr. Copper. Where was it? Somewhere around leading up to the last bull market top in 2007 or so, or shortly after. I think it was leading up to that time. It was stripped of that name. Now, they used to call copper Dr. Copper because it was a canary in the coal mine. It was one of the most accurate predictors of the health of the U.S. economy. All that changed when China came online and just started, building up like crazy. They had an insatiable demand for copper. So there was time where copper prices were doing great. They were rising, indicating the economy should, but the economy in the U.S. was doing lousy. So Dr. Copper, again, years ago had been stripped of its title of being one of the best leading indicators of economic growth, especially here in the U.S. And in recent years, it's just not correlated well with the even global economic growth. And here are a couple of what I refer to as canaries in the coal mine. These are the major, delivery companies. UPS. This is a clearly bearish pattern. I talked about this stock recently. If I'm not mistaken, we had a downtrend line. We had a breakout, which on face value, that's bullish. Here's a breakout right there, but that breakout failed. You can also see this. I had drawn here a bearish rising wedge pattern. Look at this big, massive bearish candlestick today. So what's happened? Today's candle, with UPS being down nearly 5%, has both broken down from a bearish rising wedge. It has failed the breakout of this downtrend line that was bullish at the time. But as I say, fewer things in trading are more bearish than a failed long side or bullish breakout. We also had a support level here. You can see this horizontal line capturing numerous reactions from above and below. We're smashed through there. So nothing but bearish price action in UPS. And again, a sign of non-confirmation. Here's UPS trading well off its highs. Here's a company, again, that is very indicative of the health of the U.S. economy, that's now 11% off its highs that it put in back in late 2016. Of course, the other big one here is FedEx. FedEx, until recently, was confirming trading at new highs, but we broke down below a fairly well-defined uptrend line here, and you can see some impulsive selling so far. Now, hard to write this one off yet. I'd have to study the charts a little further. Here's a primary uptrend line that it broke down below back here, but it came back up, and we're still below that uptrend line. And I can tell you, just looking at this weekly chart, Again, guys, I haven't had time to really annotate all these charts or update all of them, but there's divergence, negative divergence on the weekly, just like we had here. In fact, we haven't had negative divergence until back at this point in time. And then if you go back on the chart, I can just take a quick glance back here. I see divergence on the weekly time frame. You can see prices making higher highs back then, and that led to a drop of, well, I'd have to move that trend line to measure it, but there was a 34% drop in FedEx. So I see no reason why that stock isn't headed lower along with the rest of the stocks in the transportation index. Here's IYT for those guys, for those of you who like to trade it. I covered this one recently. Bearish rising wedge breakdown, very impulsive selling so far. This is a red flag to the stock market, guys. That's the point I'm trying to impress here. That the stocks are not confirming new highs with the rest of the market. In fact, they're breaking down from clearly bearish chart patterns, and that breakdown, unlike some others that we've seen recently that proved to be false breakdowns, this is being confirmed so far with very impulsive selling. The other ones I talked about recently, I told you guys I was quite bearish on the railroads. If I can type it in correctly here. Sorry, railroad. And let's use this one. There's a railroad index. I mean, you don't get a trend line much better than this. 3, 4, 5 reactions, breakdown. We had that horizontal support. Everything I covered a week or so ago in that sector coverage, and you can see the railroad stocks. As I said, I gave them all. It's quite a few of these. Not everyone in there, but quite a few I mentioned were very objective short trade setups. I can't post them all. It's just too many to track, but they're all doing well so far. And so there's the rails breaking down. Not a good sign for the economy. I mentioned the airlines as another one of my favorite shorting ops. And you can see since then we did break down from that bearish rising wedge. This was at the time I showed you the wedge projection. There's the widest part of the wedge. And it happened to break down right where I added that line to in that video, comes down. So this is my target. And we did get a breakdown where I had put that line before. The widest part of the wedge, which is the projected measurement. So I can see still at this point from where we're at, counter trend rallies aside, about another 8% downside in the airline stocks. So again, point being, there's trading ops on both the short and long side in this market. And if the broad market rolls over, you're going to see there's so much hot air in this market. I love shorting stocks because they tend to fall so fast once they break, especially when the market or a sector or a certain stock has gotten ahead of itself. All right, let's just take a quick look at the broad markets. Today we're seeing some impulsive selling. Here's the SPY. Look at this dump already. This is today's price action. See, this is yesterday's close right here, this dotted line. So this is today's price action. And you can see all of a sudden, for reasons I don't know, maybe there's some news headlines out there, or maybe the market just got too heavy to carry its own weight here and it's just cratering down today. And not huge. We're down 0.5%. So again, I'm not trying to be dramatic here, but that is a pretty noticeable drop so far. Now, Friday, heading into the end of the week, I pointed out these price channels and made a prediction that we'd see a breakdown and a move down, a correction this week. Now, the week's not over. What happened is, so far, initially for the first few days, I was wrong. We did break down. I was correct in that on these 60-minute price channels that I posted on SPY and QQQ. But we pushed up. We had a little kickback rally. And now all that did is put in a second divergent high. So it did not in any way, shape, or form undo these bearish technicals. The fact that we have a divergent high, we had price channels, trend line, it just means we had a snapback rally, put in a second divergent high, and now I'm seeing impulsive selling. So I still think we'll see more downside into tomorrow, and we'll just have to go from there. So we might not have unless the selling really picks up throughout the rest of the day today and into tomorrow. We may not hit the pullback targets this week, but I think that'll carry over into next week. Here's QQQ. I showed you this price channel and that breakdown. If you look closely, I had mentioned here we had this gap support, and we hit that gap support and bounced. So there's a little reaction, kickback rally, but that, just like SPY, put in an extension or a second divergent high, and so far you can see very impulsive selling, just as we had back here. Here was a wedge. This was pointed out at the time. We broke below the wedge. We didn't immediately melt down. We had a little kickback rally, some sideways trading, made a marginal new high, and then boom. And if you trade these, if you're a quick trader, those are profitable. So I think we go down. This chart, guys, I have so many lines. I have probably some more clear versions, but look at this gap right here. This is what I'm targeting. This is where I see us going down to. And I think it'll happen pretty quickly. Like I said, there's a lot of hot air and it's priced into the charts here. So there's QQQ. I'll cover IWM because I think I covered that one on Friday as well. There it is, divergent high. There was the trend line. We finally broke down from that trend line today, and the selling so far is impulsive. So we had an extension of those divergences. So pretty much my prediction is starting to play out now. It didn't play out earlier in the week as I thought it would, but yet we hadn't really gone up much higher. I mean, we're talking, I don't know, less than 1%. So, so far so good there. I'll keep this video short. I'll wrap it up here just to take a look at the daily charts because I haven't given up on those. I haven't posted a lot of analysis on the daily charts. The trend has just been, a slow but steady grind higher for the most part. But here's IWM. We still have, just like all the major indices, we still have some negative divergences in place on this most recent high. And, IWM has this quite a bit of supply here. We've had really slogged around in a trading range for going back all the way to December or late November of 2016. So it's been going on for a while now, a sideways trading range. We moved above it recently, but you notice the breakout here has been very anemic. Typically, when you have a multi-month trading range, as we did here, we had a brief but failed breakout there, came back down. We tried to break out again, came back down within the range. We broke out once more, but you notice it's been anemic. Volume has been low, price action hasn't been impulsive, and so far this breakout is failing again. So although IWM refuses to die, it also just seems like there's very little fuel left in the tank. That's my take on it. So let's just watch and see what happens there. Daily chart on the SPY, and yet another divergent high. I pointed out these divergent highs, and what I keep saying is they might not mark the end of the great bull market, but each one marks a considerable drop. And if you're trading, something like the E-minis, ES, futures, or any of the leveraged ETFs, you can certainly, make quick trades on these pullbacks, even if the primary trend is up. You can see the PPO starting to roll over. It needs to get a bearish cross right here to confirm that divergence, but we have yet another divergent high and a minor uptrend line here to watch, that yellow uptrend line, and then here's our primary uptrend line. So at minimum, my guess is very soon we're going to come back in and, wrong tool, trying to use a line tool, and visit that trend line there. And there's also nice support around that 240.32 level. You can see here that was the previous highs. We broke out, back tested, bounced up. So there's a key support level. And the bullish scenario would have us come back in and back test that level if we do drop that far and take on, move on up to new highs. And ultimately, for those of you that think this is a great new bull market in the last couple of years was just a period of consolidation and now we're on this new leg up, then you want to see these divergences taken out. And if they do, I won't be able to make a bearish case if these current divergences are taken out. So right now they're still in place. So I'm on the lookout for a break down below that 240.32 level, as well as this uptrend line. They're intersecting support levels, pretty significant levels at that. And I probably have to recalculate that minimum target drop. It's probably a little more than 5% from where we're at right now, and a potential target down here. So let me try to quantify it for you, what we could be in for. Just to come back and revisit that trend line, that's about a 2.5% drop. If we come down to that 232.50 target, that's about a 5.5% drop. And if we hit this potential target there, there's about a 10, about 11% drop, close to it. And again, I can't impress this enough. Stocks tend to correct much faster than they rise, especially when you have a valuation bubble, short interest at record lows now, multi-year lows, things like that. When the shorts are blown out, there's nobody to cover at these levels. Normally, when you have a decent amount of short interest, you're going to have shorts book profits here. They're a natural supply of buyers, and this latest ramp has just blown them out of the water. So do not be surprised if you see those 3+% down days, several of those in the next month or so. And then finally QQQ, and we'll wrap it up. A lot of you guys trade the Qs. There it is, divergent high, sound like a broken record with these divergent highs, but they play out for corrections. Each one has, it's not huge. This one here, we'll have to zoom in from top to bottom. There was about a 5.3% drop in the Qs. A couple contracts of NQ or any of the other ETFs, or even if you're just short QQQ, that's a decent swing trade for most swing traders. So there's yet another divergent high right here, and it's an extension really, or a second consecutive divergent high, and a lot like SPY, I see it going down. This would be my target. You can see this primary uptrend line starts all the way back here in 2015, numerous reactions along the way, and because of these divergences and really how overbought were recently, we're coming off those overbought levels. I wouldn't be surprised to see that trend line go in a deeper correction. So that's my analysis on the markets. Again, watch those transportation stocks. Tech can only carry the market so far. That's been the case lately, and I'm looking at some of the tech stocks rolling over, and we still have a few scheduled to report. Some of the FANGs haven't reported yet, so that could certainly be a catalyst to carry the market lower. And as I often say, sometimes companies come out with rosy earnings reports and forward guidance, and yet they still sell off. It just has to do with supply dynamics. When everybody's in, when you're all in the market, there's nobody left to buy stocks when everybody owns them. And there's very little short interest right now to cover. So that's my take on the markets. And like I said, focus on individual stocks and sectors because there's plenty of opportunities on the long and short side. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.